Today we're doing a deep dive into the world of technical indicators. We're drawing straight from Mark Larson's really practical 2007 book, 12 Simple Technical Indicators That Really Work.
Yeah, Larson's approach is interesting. He's been trading since '98, so it's grounded in, actual experience.
Exactly. And he distills it all down into this straightforward, actionable way to look at the market. So our mission today isn't just about listing a bunch of indicators.
No, it's deeper than that.
It's about grasping the real power these tools have, and also the absolutely crucial role of parameters. That seems key.
Oh, parameters are huge for Larson. We'll definitely get into that.
And how, together, these things give you what he calls priceless market snapshots. These aren't just charts. They're like roadmaps, right? To help you make informed buy and sell decisions no matter what the market's doing, up, down, sideways.
Precisely.
So let's unpack this. How do we find what truly works to understand the heartbeat of the market?
Well, what's really compelling about Larson, I think, is how he just cuts through the clutter. There are hundreds, maybe thousands of indicators out there.
Right.
And he isolates just a handful he truly believes in. He doesn't just say what they are. He gets into the why they matter and, crucially, how to actually apply them. Whether the market's bullish, bearish, or just chopping around.
And he makes a pretty bold claim right off the bat, doesn't he?
He does.
His core idea, technical indicators are fundamentally more important than the fundamentals for figuring out when. That timing piece. When to buy, when to sell.
Exactly. It's all about the timing for him. And if you think of the indicators as, like, engines, then the parameters are the specific fuel that makes them run right. He hammers this point home. Parameters are the most essential part.
That cake recipe analogy he uses.
Yeah.
Yeah.
The mother's prized cake recipe. It's brilliant. Even a tiny tweak to the ingredients, the parameters in this case, can totally change the outcome. He says his own success came from mastering and, constantly refining the right parameters, finding that sweet spot.
That makes so much sense. It's not just the tool, but how you tune it.
Precisely.
And it's interesting, he wasn't always a technical trader, right? His own journey.
No, not at all. He started out doing buy and hold real estate at 24. Pretty standard stuff.
Okay.
But by 32, he'd completely shifted to this more aggressive trading style, really leaning on technical indicators.
And that shift actually helped him, didn't it? Like with the 2000 correction.
Yeah, he apparently used his indicators to warn investors about the looming bear market back then. His whole philosophy kind of boils down to that phrase he coined. The key to success is knowing when to buy and when to sell.
That phrase really sets the stage. So to figure out that when, we need to understand the basics of these indicators first.
Right. And broadly, they fall into two main camps. You've got lagging indicators.
Lagging. So they confirm moves after they happen.
Exactly. They follow the price action. Good for confirmation, but, late.
Okay. And the other type?
Leading indicators. These are the ones that try to anticipate or signal changes before the big price moves happen. Potentially more profitable, but maybe more false signals too.
Got it. And underpinning a lot of this, he talks constantly about volume, doesn't he?
Oh, volume is critical in his framework. He has a saying, volume goes with the trend. Meaning it's normal, actually healthy, to see volume pick up when prices are rising. And for it to decrease when prices are falling, that confirms the trend is, legitimate.
Okay, that makes sense. Healthy confirmation.
But here's where it gets really insightful, according to Larson. When volume expands, really picks up, while prices are falling, that's a big red flag. It signals strong enthusiasm among sellers, real bearish conviction.
So lots of people rushing to sell.
Exactly. And conversely, strong volume in an uptrend means committed buyers. His takeaway is simple. More is better for volume confirming the price direction.
More conviction.
Right. Some traders even get fancier and put moving averages on the volume itself, trying to spot breakouts and participation early, like a trend within the trend.
Interesting. Okay, so with that baseline lagging, leading, the importance of volume, let's maybe dig into some of Larson's specific favorites, starting with moving averages.
MAs.
Yeah, moving averages, they're kind of the visual backbone, your basic price compass.
So just the average closing price over a set period, like 20 days, 50 days, 200 days.
Yep, exactly. You pick the period. And the interpretation is pretty intuitive. Price consistently above the MA, generally bullish, suggests upside.
And below means potential trouble. Generally, yeah, downward potential. And that 200-day moving average, that's like the big one, widely seen as the strongest long-term support or resistance level, a real line in the sand.
He also talks about different types, right? Simple versus exponential, SMA and EMA.
He does. Simple moving averages, SMAs, weigh all the prices in the period equally. They're slower, smoother. Larson tends to prefer these, finds the signals maybe a bit more reliable.
Okay. And EMA.
Exponential moving averages, EMAs, give more weight to the most recent prices, so they react faster, quicker signals.
Pros and cons to both, I guess.
For sure. And Larson actually suggests being dynamic. If you're bullish, but things feel like they're shifting, maybe shorten your MA period, say, to 10 or 20 days instead of 30 or 40.
Why? To get out quicker if needed.
Exactly, to get faster sell signals. Sticking to a longer period when the market's turning can mean you give back too much profit.
That makes sense. Adaptability. So how do you know if a signal is real, like a price crossing an MA? How do you avoid false alarms?
Patience is key, according to Larson, especially with crossovers like a short-term MA crossing a longer-term one. He insists on what he calls a 3-day confirmation rule.
3 days?
Yeah. Only act if the signal, the price staying above or below the MA or the crossover itself holds for at least 3 consecutive days, reduces the whipsaws.
Okay, wait for confirmation.
Okay.
Especially around that big 200-day MA.
Definitely. If price is testing that level, you really want to wait and see clear proof of direction before jumping in.
Got it. He also mentions gaps. What are those about?
Oh, gaps are significant price jumps. A gap up is when the price opens much higher than the previous day's close, often a sign of strength. Maybe good news came out overnight.
And a gap down is the opposite, weakness.
Right.
Price opens way lower, usually bearish. And this ties back to volume again. Larson says supply and demand is none other than volume.
Okay.
So if you see a gap and it happens on a huge spike in volume, say 1.5 times the average daily volume.
That shows real commitment behind the move. Much higher odds, it continues in that direction. It's that energy confirming the price action.
Volume confirming commitment. Okay, that's clear. What's next? Balance of power. BOP. Sounds intriguing.
Yeah, balance of power BOP is fascinating. It tries to look beneath the surface and see what the big institutions are doing.
Like the hedge funds, mutual funds, that kind of thing.
Exactly. Are they systematically buying large blocks of stock accumulation, or are they selling distribution? We're talking trades of like 10,000 shares or more.
And how do you see that?
It's usually plotted as a line above or below a zero line. Positive BOP suggests institutional buying is dominant. Negative BOP suggests they're selling.
Okay, and he mentions a change of character with BOP.
Right. That's when the indicator signals a shift in that underlying institutional flow, maybe from selling pressure to neutral, then to buying pressure, or the reverse.
What parameters does he like for BOP?
He settled on a 12-day simple moving average for the BOP indicator itself. He found shorter periods gave too many false signals, longer ones were too slow. That 12-day was his sweet spot.
And this leads to something really important he flags.
Yeah.
BOP divergence.
Yes. BOP divergence. This is critical. It's when the stock's price is shooting up, looks great on the surface.
Making you want to buy.
Totally. But the BOP indicator is simultaneously showing negative divergence, meaning institutions are actually selling into that strength.
Whoa.
Larson calls it the stock market exchange trying to trick you into buying. The big money is quietly getting out while retail buyers are piling in.
That's sneaky. Are there examples?
He points to historical cases like Enron, Tyco, Lucent, where this divergence was apparently visible before things went really bad. It's a serious warning sign.
Definitely something to watch out for.
Whoa.
He also mentioned a grouping of moving averages.
Yeah, another powerful signal he watches for. Specifically when the 20-day, 50-day, and 200-day moving averages all kind of converge and come together and touch at one point.
All three touching.
Yeah. He says this often signals a major move is coming soon, one way or the other. He calls it a run-to-the-bank signal because the potential is huge.
But you don't know which way it'll break.
Right. That's the catch. You need other indicators to help confirm the direction of that breakout.
Right.
But the grouping itself signals big energy is building.
Okay, fascinating stuff. Now, what about this duo he talks about with the 90% success rate? AMTD and PRC.
Ah, yes, the power couple, AM9TD and PRC. Moving average, convergence, divergence, and price rate of change.
90% success. That sounds almost too good to be true. How does that work?
Well, that's his claim when they give exact crossing signals together. Let's break them down. MCD uses 3 exponential moving averages.
3 EMAs. Okay.
And the signals aren't always just about the lines crossing perfectly. Sometimes it's just them coming very close together, maybe 2 lines touch and the third is right there.
And he prefers seeing it in a specific way.
Yeah, he likes the histogram form of MACD, the bar chart version. He finds it makes spotting that change of character, those buy-or-sell shifts, much clearer visually, more immediate.
Okay. And PRC, price rate of change.
PRC is an oscillator. It basically compares today's closing price to the closing price from a set number of days ago. And his secret ingredient here is the parameter 21 days.
21 days. Why that number?
He felt it hit the right balance enough history to smooth out noise, but not so much that it lagged too badly on turns. He also uses a 15-day PRC sometimes for earlier warnings.
And the signals.
Bullish if the price and the PRC line cross above a 50% level on the indicator. Bearish if they cross below 50%.
So if PRC drops below 50, that's a potential sell signal.
Could be. Larson suggests maybe selling half your position or even all of it if that happens, especially if other indicators agree.
And this isn't just for active trading, right? He uses it for long-term stuff, too.
Absolutely. He tells this story about checking his wife's 401k, looking at Pfizer stock using PRC. Yeah. His system showed weakness based on PRC, so they sold it. His point is that all your holdings, even retirement accounts, should be reviewed regularly. He says it takes him no more than 2 minutes per stock with a system he trusts.
2 minutes. That's efficient.
Right. And he also used the WorldCom collapse as an example of how PRC could help identify shorting opportunities, betting on a stock going down.
And when to get out of that short.
And when to cover the short, close the trade.
Okay, so MACD and PRC together, aiming for that high probability setup. What else is in his toolkit? TSV and RSI TSV.
Right. Another pair focused on price and volume. Time-segmented volume, TSV, is a leading indicator based on both price movement and volume.
Leading, okay. And signals.
He looks for ideal entry and exit points as the TSV line crosses its own 50% level, and the parameter he favors here is 18 days.
18 days for TSV. But he stresses something important here, doesn't he? About not using just one indicator.
Crucial point. He repeats this often. TSV alone, or any single indicator, isn't enough. He personally requires no fewer than 7 indicators to align before he feels confident making a trade.
7. That's a high bar for confirmation.
It is. It's about reducing false signals and increasing probability.
So what's RSI TSV then? A combo.
Exactly.
Yeah.
RSI TSV is Larson's own creation, basically. He liked J. Wells Wilder Jr.'s Relative Strength Index, RSI, which compares gains to losses, but found it confusing sometimes on its own.
So he makes it with TSV.
Yeah. He combined them, tweaked it with 3 different parameters, and claims this hybrid indicator has a 90% accuracy for buy-sell signals when it crosses its center line.
Another 90% claim. Patience seems to be a recurring theme.
Absolutely. Waiting for those clear crosses on indicators like RSI, TSV is key.
Okay, next up, inertia. Sounds like physics class.
It kind of is. Inertia measures a stock's momentum based on its volatility, its tendency to, stay in motion, like Newton's laws, but for stocks.
How's it measured?
On a scale from 0 to 100. Below 50 means negative inertia, bearish, or maybe just neutral. Above 50 is positive inertia, bullish momentum.
And parameters.
He uses settings of 10, 14, and 20. Again, the specific numbers aren't magic. It's about testing what works for you and the time frame you're trading.
He calls inertia a confidence builder. How so?
Because it helps confirm the price trend. If the price is moving up and inertia crosses above 50, that builds confidence in the bullish move. Same if price is falling and inertia drops below 50, it verifies the direction.
Gotcha. He has an example with the Dow Jones.
Yeah, from 2007. He shows how inertia signals could have potentially helped avoid a big drop like 542 points and then get positioned for a big rally over 1,600 points. Shows the potential impact when used correctly.
Okay, confirmation is key. Finally, average true range, or ATR. This one sounds important for risk.
Hugely important for risk management. Average true range, ATR, measures volatility. It tells you the stock's average daily travel distance, how much it typically moves up or down each day.
How does it calculate that?
It looks at the greatest of these distances. Today's high minus low, or the distance from yesterday's close to today's high, or yesterday's close to today's low, captures the true range, including gaps. Larson likes a 15-day parameter for ATR.
And its main use is for setting stop losses.
That's its primary job for Larson. He sees people constantly making the mistake of setting stops way too tight.
Yeah, I've done that. Get stopped out, then it rips higher. Frustrating.
So frustrating. So Larson's rule of thumb is simple. Double the current ATR number to set your stop-loss distance.
Double it. Okay, give it room to breathe. Example.
Like, if Apple's ATR is $3.19, you'd set your stop $6.38 below your entry price or below the current price if you're adjusting it.
And you should adjust it.
He suggests adjusting it daily or weekly, trailing it up as the price moves in your favor to lock in profits.
That makes sense. Protects capital, limit losses.
Exactly. And hey, if you get stopped out but still like the setup, you can always look to re-enter later. It's about managing the downside.
What about ATR for market signals?
Yeah, it can offer clues. Really high ATR often happens near market bottoms. Think panic selling, huge daily ranges. Low ATR is common during sideways grinds, maybe near market tops or during consolidation. Volatility dries up.
Interesting context. Okay, so we've covered a lot of individual indicators. How does Larson pull this all together into a strategy? Stock scans.
Exactly.
Yeah.
Stock scans using 6 important indicators. This is his way of tackling that analysis paralysis.
Right. Trying to look at hundreds of charts manually is impossible.
Totally. So the scans are like that cake recipe again. You combine specific ingredients, the indicators you trust, with the parameters you've refined. To automatically search the market and find stocks that meet your exact criteria, whether you're looking for bullish or bearish setups.
And he shows examples that worked.
Yeah, he highlights scans that found big winners, like a stock going from $33 to $51, and also scans that identified great short opportunities, like EMC falling from $46 down below $9.
So the scan filters for the best potential candidates.
Right. Focuses you on the cream of the crop stocks where multiple technical signals are aligning. Remember, he likes seeing at least 6 indicators agreeing. It's about probability stacking.
Building that confidence through confluence makes sense. And then the actual trading strategies, he keeps it simple.
Refreshingly simple, actually. He boils it down to just 3 investment strategies that work in any market.
Okay, what are they?
1, buy a stock when it's going up. 2, short a stock when it's going down.
Straightforward.
And 3, if you're trading options, buy a call option if you think it's going up, or buy a put option if you think it's going down.
That's it. No complex spreads or anything.
Nope. His view is that overly complex strategies often come from a lack of real faith in your technical indicators. If you trust your signals, you just act on them directly.
Interesting perspective. So how do you build that trust? Especially for you, the listener, starting out.
Practice. Relentless practice. He really encourages using charting software. He mentions TC2000 or Profit.net to test these indicators yourself.
Like paper trading.
Yeah, or just back testing. Save snapshots of your analysis. See what worked, what didn't. Build up years of data, even if it's simulated. That's what builds real deep confidence in your system. Practice makes perfect, or at least proficient.
So wrapping this deep dive up, it really seems like Larson's message is that market success isn't magic or luck.
Not at all.
It's about finding indicators that click with your style, obsessively refining those parameters, and developing the patience to wait for confirmation.
That sums it up perfectly. And remember the parameter basics. Shorter means faster reactions, longer means slower, more confirmed signals.
And adjust them as the market changes.
Definitely. And always, always backtest to build that conviction. You need to trust your tools when the pressure is on.
Larson famously says the stock market goes up, down, and sideways. True success means profiting in any direction.
That's the goal.
So the final thought for you listening. With this understanding of these technical tools, the power of parameters, what new opportunities might you start seeing now? Not just in single stocks, but in the whole market's constantly shifting rhythm.